The world of leverage, from good to very bad. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. Today, welcome back, Alex, who had a lot to say in the news article today about the situation the world now finds itself in, with government debt spiraling out of control, a topic I'm also strongly concerned about. So how are you going today, Alex?
I'm going well, sweltering in Sydney.
Well, it's pretty warm up here in Brisbane as well. I walked in today and needed the aircon a little bit to recover. But I'm good now, so we're good to go.
Oh, that's good.
The topic you talked about today is one we've been talking about all year. It's something that I think is really quite important, particularly as we approach the end of the year. I think it's something that really we're going to be heavily focused on again in 2024, because I think a lot of this is really coming to a head, and that's this idea of government debt. Now, in the article today, you really highlighted just how big it was. So can we start off by maybe exploring that concept? How big of an issue are we talking about?
So in the debt right now, government world debt is around 97 trillion, of which three countries make up 50%. Now, we all know Japan has had its issues and has been, using debt to try and get out of its situation for years. But if you think about the two growth engines of the world over the last decade, it's been China and the US. And that has been driven by debt. If it wasn't for China right now, we never would have recovered from the 2008 recession. And really what drove them through the decade, which was basically cheap debt, high leverage, is what is going to undo them in the next decade. And that doesn't just apply to countries, it applies to individuals, assets, and countries. So yeah, where leverage was great for the last decade, it's not looking great for this decade.
So that's really interesting, because we don't often like to think of debt or leverage in that positive term, but the point you're making is really valid. It did work. We can't deny the fact that that's really what, particularly in the case of China, as you highlighted, what pulled us all out of that abyss that we were facing after the great financial crisis. So we're not, you don't think, and I agree with you, that we're going to be so lucky this time around. Is it like, what's really the reasoning behind that? Is it just because we've reached the limit of how far we can push this? Like, why is it now that's the issue?
Well, we obviously know inflation's been driven by this, but let's just take it back even further than when we got to the point of inflation. And let's look at what drove, say, stock markets, so companies on the stock markets over the last 10 years. So the way I see it is there were two types of companies. There were companies that grew through acquisitions of cheap debt. So they used cheap debt, they bought acquisitions, they bought revenue. Then you also had these other companies that decided to invest. And by investing, they improved their productivity. Now, you can see in the US and Australia right now, productivity is on a decline, or, at least even decline in Australia in the last year. And the reason I believe this is going on is because we have not invested in productivity, because companies, governments, everyone was not rewarded for investing in productivity. They were rewarded in taking cheap debt, buying revenue, and then paying it down. So what we're seeing right now is the end of that cycle where these companies got rewarded for it. And we're now at the point where they're paying more on that debt, but they also haven't paid down that debt. So usually when you bought companies, banks would lend you on a variable interest rate, let you buy it, let you revolve it. So say you borrowed $100 million for a company with 100 million revenue. You might have had 2% variable debt, which is now 6. But what it didn't factor in is the reinvestment, because you cannot maintain $100 million revenue for a business without buying new machines, investing in programmers. You have to invest to keep up with the market, to improve productivity, to compete with these other companies. They haven't done that. Then you had these other companies that decided to invest in productivity. They may have borrowed $100 million to gain maybe $40 or $50 million in revenue, but it was good revenue because it improved their productivity, it improved their product, their competitiveness, and they are who these now zombie companies are competing with in the future. So it's opening the market really nicely for these companies that have invested in productivity and competitiveness. And it is creating a lot of other companies that just cannot compete because the debt is more expensive. They've never paid it down and they have to reinvest, and there's no money left to reinvest.
That's such an interesting way to look at it. And I don't think I've heard anyone describe it like that, because yes, we tend to look at the country level and just talk about this government debt, but we never actually look at what's underlying that in terms of the individual companies, as you're describing, that are really adopting that same mentality. So that's quite interesting, I think. Do you, like, maybe pushing that a little bit further, do we think that the interplay between those companies and countries pushes out, because obviously they're not all as bad as each other, right? Like, we've got some countries that are playing this game a lot better, that aren't as leveraged. We've got some companies that aren't doing that. How do you look at it in terms of the lower leverage? And you've just highlighted in terms of productivity the opportunity that's there for those countries that companies that invested, but is it kind of the same thing for countries at a country level, the ones that have taken that a little bit more sensibly, that approach?
Well, if you look at a country and you compare, say, Switzerland with a GDP to debt ratio of 41% compared to America, now 33 trillion, we know that their debt is getting out of hand. We know that their potential deficit next year, 2 to 3 trillion, I think, is a fable. Let's go for 4 to 5 trillion. They're now spending more on interest than they do on defense, and it's America. So that's been their big spend. And they're fighting Ukraine, Israel. They're supporting these wars that are going on in the world, and their interest expense is more than it. So it has become completely out of hand.
And election year. Let's not forget the election year argument, right?
Yeah. But let's say there's a huge technological advancement next year. Let's say that someone comes out with self-driving buses, there's a huge investment, and it creates productivity in the environment. Well, the US is not going to have the same opportunity to invest in that technology as, say, Switzerland.
Right.
Switzerland could increase their debt knowing that they'll be able to pay it back because their productivity increases. Whereas these other countries like Japan, the US, China, Greece, they're hamstrung. They are going to get caught up in their interest expense and not be able to invest in their infrastructure and productivity. And they are going to miss opportunities and lose competitiveness as they go.
And this is the old, Robert Kiyosaki, rich dad, poor dad angle, good debt versus bad debt. What you've just described there should be basic knowledge, right? Like, it's not really that complicated. If you take on that debt because the opportunity is there to really expand the economy, it makes a lot of sense. But that's not what's happened. and we know that.
What's been really interesting, just going back to rich dad, poor dad, good debt, bad debt. Take, for example, manufacturing, which I know a little bit about. If you bought a manufacturing company in the last 10 years for $100 million, you did not have to pay the debt down. It was, the banks looked on it so highly that it's a revenue push and don't worry about it. Whereas if I was to invest in equipment, which is a productivity increase, banks looked at it as a risk because I did not have revenue associated with that equipment. Therefore, my current cash flow, my current revenue had to support the risk. So the way the debt was looked at was the company that bought the new equipment were forced to pay it back. They were usually forced onto fixed interest rates that were forced to pay it back fairly aggressively. Whereas these other companies just use the debt to revolve. So if you think about it from that point of view, one company was absolutely punished in the past for being creative and looking to the future, and another company was rewarded for quick wins. And so here's the conundrum, and here's going to be the undoing. One was a good debt and you were punished for the good debt. One was a bad debt, you were rewarded for the bad debt. And this is what's going to flip in the next decade. If interest rates continue at this level, there is going to be the company with the higher revenue will fast become uncompetitive and lose market share quickly.
Makes a lot of sense. So I suppose we've explored all of that, and I have no doubt we'll continue exploring it as we move into next year, because it's going to be a real topic that's front of mind for everyone. But how does this flow through to the actionable opportunity for us? So particularly for assets, obviously there's an impact of all that debt flowing into assets. We've talked about that in the past in terms of liquidity and what that does to asset prices. But in particular, gold and silver, where do you see all of that coming together?
This unleveraged assets have to be a good thing going forward. It's going to happen in countries, it's going to happen to companies. And if you've got assets that do not have huge debt against them, they are not going to depreciate as quickly as stocks. They are not, there's not going to be forced liquidations. If you look at bonds, they've been underperforming for years. They may start to improve, but now you have counterparty risk against them.
Yep.
So you now just have to start looking at assets for assets. Houses everywhere have huge mortgages. Property have huge mortgages. Look at the commercial property market in the US. It is unraveling because there is no income against it. Houses are a bit different because it's based on wages, and wages are seemingly starting to get back up there again. So it's not necessarily as bad, but it's all about leverage. So the forced liquidations, the volatility that's going to happen in the next year are going to be against leveraged assets. So bonds, we talk about the basis trade that's going on with the yen. It has the potential to unravel quickly. It's got counterparty risk. It's operating on tight leveraged margins, whereas assets like gold, silver, Bitcoin, commodities in general do not have counterparty risk, do not have leverage, and are more likely to see gains in the future.
Love that explanation, and it makes a lot of sense to me, because this idea of having something that's not leveraged when we're going into a leverage crisis, quite likely. I mean, it almost requires a miracle to avoid crisis ahead when you consider everything you've talked about today. The only solution to that is something that's not leveraged. It makes perfect sense. Like, that's the answer.
Hopefully.
Well, we're all hoping that, because we're holding a lot of it. So, well, thank you for that today, Alex. Really appreciate that. Love that discussion. And I certainly think we'll be back to it again as we watch it unfold over the next sort of start of 2024. All right. And thanks for everyone for watching. Remember, you can reach out on any of those social platforms if you've got any comments or questions you'd like to ask. And that's us for today, but we'll talk again soon.